So picture this, it's early 2026, and a major global crisis just hits, sending shockwaves through the markets. As investors flee from anything that looks risky, Bitcoin, digital gold, it totally fails its big test as a safe haven and just tanks. And then, something really weird starts to happen. While the big institutional money steps in and puts a floor under Bitcoin's price, the companies that actually create the Bitcoin, they go into an absolute freefall.
Right, so this is the big question, the real head-scratcher we're going to crack open today. Why on earth would the companies that produce an asset just get completely obliterated while the asset itself is finding its footing? The answer, it turns out, reveals this massive tectonic shift happening right underneath the entire industry.
I mean, this just lays out the paradox perfectly. Just look at the numbers. Bitcoin takes a hit, sure, but the big players see a bargain and start buying. But the mining stocks, they just totally disconnect, get absolutely pummeled, dropping 40, 50, even 60%. This isn't just a correction, folks. This is a sign that the fundamental business model is broken. And to figure out why, we kind of have to perform an autopsy.
So, let's put one company under the microscope. American Bitcoin Corp, or ABTC. It had this insane 51% collapse in a single day. But that wasn't the real problem. It was a symptom of a much bigger disease that was infecting the entire sector. If we can understand what went so wrong here, we can diagnose the whole industry.
What the ABTC disaster really did was pull back the curtain on three, let's call them fatal flaws in the whole mining business model. First, there's this weird accounting rule that makes perfectly healthy companies look like they're going broke. Second, a kind of financial quicksand known as the dilution death spiral. And third, a speculative bubble that was built on nothing but hype, not actual numbers. Let's break them down.
Okay, so it all kicks off with the accountants. Because of this one rule from FASB, miners have to report the value of their Bitcoin holdings at the end of every quarter. Now think about it. A company could be absolutely crushing it, mining super efficiently, making money. But if Bitcoin's price dips right before they file their report, boom, they are forced to report a huge make-believe loss. It just creates this insane volatility in their earnings that makes institutional investors run for the hills. And this is the real kicker. If you're managing a pension fund or a mutual fund, you need some level of predictability. This accounting nightmare makes the whole sector basically untouchable. I mean, how can you pour serious money into a company when its entire profit report can be wiped out by a bad week for Bitcoin, even if the business itself is running perfectly? You just can't.
All right, flaw number 2 is honestly even nastier. See, mining is like this relentless arms race. You're always having to spend cash on faster, newer machines just to stay in the game. And where do they get that cash? They sell new shares of their own stock. But here's the trap. When their stock price goes down, they have to sell way more shares to raise the same amount of cash. And all that selling just pushes the price down even further, which means they have to sell even more shares next time. It's a vicious cycle, a total death spiral.
So you've got these huge structural problems just sitting there like a time bomb. And what finally lit the fuse? Well, it was a simple, cold, hard fact. For a lot of these companies, it started costing more money to mine one Bitcoin than they could sell it for.
Yeah, this timeline here really shows you how it all came together in this perfect storm. First up, you had the 2024 halving. That sliced their main reward right in half. Then, the extra money they were making from transaction fees just fell off a cliff. And all the while, more and more miners were plugging in, cranking up the difficulty, making it harder and harder to compete. Their profits were getting squeezed from all sides.
And this chart says it all. By early 2026, the average cost for these guys to mine one single Bitcoin had blown up to about $83,000. But the price on the open market was only $68,000. Just let that sink in for a second. You are spending $83,000 to create an asset that you can only turn around and sell for $68,000. That's not a good business.
Yeah, the math just completely fell apart. The old model of just buying machines, plugging them in, and printing Bitcoin had hit a brick wall, an economic dead end. The entire industry needed a new reason to exist, or it was simply going to vanish.
But that's where things get interesting. This crisis forced a change, what we're calling the Great AI Pivot. See, the sharpest operators in the space had this light bulb moment. They realized their most precious asset wasn't the Bitcoin they were stacking or the machines in their warehouses. It was the power plugs, the massive amounts of cheap, grid-connected power they controlled.
So check this out. At the very same time the miners are on the brink of collapse, the entire AI industry is running into its own massive wall, a huge power shortage. You can plan to build these giant AI data centers, but actually getting them hooked up to the power grid, that can take 5, 6, even 7 years. But the Bitcoin miners, they'd already solved that puzzle. They were sitting on gigawatts of power, all juiced up and ready to go.
And just like that, a whole new business model was born. So forget about trying to ride the crazy waves of Bitcoin's price. The new game is all about signing long-term leases with AI companies to provide them with power and data center space. It's predictable, stable revenue. These companies are shifting from being crypto speculators to basically being specialized landlords for high-tech computing. They value less on their Bitcoin and more on their megawatts.
And the money here, it's just staggering. Wall Street is now slapping a valuation of up to $17 million on a single megawatt of ready-to-go data center power. All of a sudden, the long-term contract for that electricity is worth way, way more than the crypto miners you have plugged into the wall. This is the engine driving this massive pivot into AI.
So where does that leave everyone? Well, this huge pivot is basically splitting the industry in two. There are clear winners and clear losers emerging, and we can now pretty clearly sort all these companies into 3 different camps based on how well they're adapting to this new world.
Okay, so in Tier 1, you've got the top dogs, the apex predators. Companies like Cipher Mining and TeraWulf, they saw this coming and went all in on the AI pivot. They have rock-solid financials, hardly any debt, and they're landing these huge multi-billion-dollar deals to power AI. Now, CleanSpark is in this Tier 2, but for a different reason. They're still a pure miner, but they're just the best at it, the most efficient, lowest-cost operator out there.
Then you've got Tier 2, the ones in the middle of this big transition. We're talking about the giants like Core Scientific, Riot, and Iron. They've all announced massive partnerships with huge names like CoreWeave, AMD, and Microsoft. But the catch is, they have to spend a ton of money to actually build out these new facilities, and there's a lot of risk involved. These are what you'd call wait-and-see stories. The potential is huge, but so is the risk.
And that brings us to Tier 3. These are the ones who are, frankly, just fundamentally broken. Take a company like Mara. Their cost to produce a single Bitcoin is an insane $164,000, and they're drowning in billions of debt. In ABTC, well, we already know that story. It was all hype, no substance. Their business model just doesn't work anymore in this new world.
So, let's put it all together in a simple cheat sheet for 2026 Tier 1. Are the winners, the ones who either mastered the AI pivot or are just incredibly efficient at mining. Tier 2 are the ones to watch. They've got the big deals, but they still have to prove they can pull it off. And Tier 3, those are the ones trapped by the economics of the old world.
And all of this leaves us with one last, big picture question to chew on. As the lines between the digital world and the physical world keep blurring, maybe we're learning that the ultimate source of value isn't the most clever piece of code or the most decentralized network. Maybe the future of digital assets isn't really about elegant code after all, but about the raw, brute force reality of controlling power.